Hi, my name is Gina Joseph, and I'm here to tell you about Ctrip, an online travel agency serving China. I think you should sell it from your holdings because the company is destroying shareholder value, it's entering its maturity phase in the corporate life cycle, and it has much weaker financials than its peers, while the market still thinks it can beat its fate.
The CFROI is falling towards the cost of capital, yet the company keeps investing in new assets. Since CFROI is falling and asset growth remains high, this means the company is destroying shareholder value. The fall in CFROI is being driven by the fall in sales growth and margins. The fall in sales growth is due to the steepening competition among Chinese online travel agent sites such as Elong, Alitrip, Priceline, and Expedia. These companies are gaining market share from Ctrip. Another reason sales are falling is because the Chinese airlines are cutting their fixed commission rate. The fall in margins is due to the increase in OPEX as Ctrip tries to keep up with competitors who are increasing marketing spending as well as spending on product development. The combination of the fall in sales growth and the increase in asset growth caused the asset turns to fall, meaning the company's assets are becoming more inefficient. In addition to declining asset efficiency, Ctrip is not generating any free cash flow and had to take on debt when invested in Qunar. All these are major red flags for Ctrip. The stock price keeps climbing high. This is likely due to high sentiment from Ctrip's deal with Qunar, in which major Chinese firm Baidu had a substantial stake. However, I believe the stock is still overpriced because the market is missing the aforementioned red flags. This is a scenario in which Ctrip performs as the market expects. In order for this to happen, the CFROI in 5 years would have to match its level in 2012, and the growth rate would likely have to be at around 7%. This is very improbable. If you look at the CFROI chart, it is very clear that the company is entering its maturity period. The company has been fading since 2010, and the CFROI is now very close to the cost of capital. When a company enters its maturity period, it is very unlikely the CFROI will be able to grow again. Inevitably, asset growth will also have to fall, because a company cannot invest cash it doesn't have forever. Here's a comparison between Ctrip and one of its peers, Priceline. Priceline's CFROI is well above its cost of capital and has been since 2009. In addition, the company's asset growth has been very high, which combined with the high cost of capital means the company is effectively creating wealth. Priceline has demonstrated a past good strategy. When the CFROI was near the cost of capital, the company generally had low or even negative asset growth. Ctrip, on the other hand, kept its asset growth high, while CFROI was extremely low, thus destroying shareholder value.
In conclusion, I think Ctrip's destruction of shareholder value, its poor position in the corporate life cycle, and its weak financials compared to peers is why you should strongly consider selling Ctrip from your holdings. Thank you so much for listening.